Welcome to Module 4. We have covered the how and the where. Now, let's tackle the why. Why should we choose one stock over another? We're going to look at fundamental analysis. And fundamental analysis is the process of studying a business core financial health to determine its true worth. It helps you to invest with conviction and not emotion. So when you carry out your fundamental analysis very well, it's going to help you to invest with facts, knowing fully well that you have discovered the intrinsic value of a company. And here we don't do with emotions, right? So emotions is a no-no when it comes to investing in the stock market. So it helps you to carry out your analysis very well and help you to make the right decision. See you in my next video. Alright, so in this module, we are going to look at how to deconstruct the three main financial statements. We calculate and interpret key financial ratios, how to locate and analyze the Nigerian company's report, evaluate microeconomic factors, assess the quality of management and corporate governance, then introduce the method for calculating a company's intrinsic value. So by the end of this module, you won't just look at a stock price, you will look through it, examining the engine of the business. This is the difference between speculation and educated investing. I'll see you guys in my next video. Alright, welcome to this video. You might be hearing fundamental analysis, FA. What is fundamental analysis? Now, let's look at the definition. It is the analysis that has to do with what? Analyzing a company's financial record, company's management, industry, and what? An economy. Now, the goal of this fundamental analysis is to determine the company's intrinsic value. When we say intrinsic value, what we mean is to determine the company through what? Now, if the stock price is below the intrinsic value, it is a buy opportunity. So the essence of looking at the true worth of a company, that's intrinsic value, is to know when to buy and when to sell. That's why we call it a fundamental analysis. And the core principle is that over the long period of time, the stock price will eventually converge with the company's intrinsic value. So for some companies that its stocks are undervalued, once you're able to identify the intrinsic value and you buy those stocks, over a long period of time, the company will grow to meet up its intrinsic value. Now, the core philosophy of fundamental analysis is simple. Price is what you pay and value is what you get. We use fundamental analysis to find companies where the market price is currently undervalued compared to what we calculate, that's the business true worth, talking about the intrinsic value. So this discipline is the cornerstone of value investing, right? So when you're able to identify a company when it's undervalued and you buy such company, the true the true investing or the value investing is when you buy such company and the company grows over a long period of time to give you higher returns. That's what we call the value what investing. And you cannot invest in a company if you don't truly know the intrinsic value of that company. I will see you in my next video. Alright, welcome to this video. So in this video, we'll be talking about how to read the financial statements, right? So we have the income statement, which is the profit and loss account. It shows the company's financial performance over a period. Most times it's quarterly, sometimes it's yearly, sometimes it's in 6 months. Now we're also going to look at the revenue, that's the total sales that the company made in that period of time. Then the operating expenses, the cost of the business. Then the net income, that's the profit remaining after all costs and tax must have been deducted, right? And after you have looked at all these things, it shows you how profitable the business is. Now, I would like you to know that the income statement is like a company's report card, and this is where investors focus heavily on to identify the net income, right? But you must track the revenue and the expense line to understand how they got to that profit number or how they made a loss, because every entrepreneur is in for either profit or what, or loss. And from your deductions or from your analysis, you should be able to know whether the company is growing in sales or whether they are just cutting costs. So these are the things that will help you to determine whether actually this company is it worth investing in, right? So when you go through their scorecard and see how they perform, their income statement, their total sales, the cost of running the business, then after looking at these things, you should be able to say or to induce whether the business is profitable or not. So once you have been able to gather all these informations, you can now make your decisions or whether to invest in a company or not. I'll see you guys in my next video. All right, so in this video, we're going to look at reading the financial statement part 2, right? So here we need to understand the balance sheet of a company. So the balance sheet is a snapshot of a company's financial position at a single point in time. Now there's an equation we are going to solve here, just a little bit of mathematical equation. So the equation says that for you to give a go ahead order, right, you need to look at an equation that we have here where we said the asset is equals to the liabilities plus the equity. Now when we talk about asset is what the company owns. Cash, inventory, property, these are assets, right? What is being owned by the company. Then when we talk about liabilities is what the company owes, right? Debt, account payable, right? So anything that the company owes somebody is called liability. Then the shareholders' equity, these are the owner's stake in the company. So now this should be able to answer the question, what does the company own and what does the company owe? Now the balance sheet is the company's ledger, that's for advanced economics. It is crucial for assessing financial stability. So you know how stable a company is financially when you look at their what? Their balance sheet. When you look closely at the liabilities, it helps you to determine the debt risk, and we analyze the assets to see how much cash and valuable property a company hold. If this equation does not balance, that means there's a problem somewhere. And when you notice something like this, it's trying to tell you or it's trying to give you a sign that this company is not what you should invest in. So there must be a balance for the equation to be what? To be complete. All right, so we are still in reading the financial statement, right? So now we're going to look at what we call the cash flow statement. So the cash flow statement tracks cash inflows and outflows over a period of time. So this is trying to tell us how it is trying to show us how cash moves into the company and leaves the company over a period of time, right? The reason why this cash flow statement matters is that profit can be manipulated, but cash is king. So when you can see the way the cash flows into the company and the way cash leaves the company, at least you'll be satisfied, right? Then when we talk about the cash flow statement, it's divided into three. We have the operating activities. So the operating activity has to do with cash from running the core business activities, right? So the cash that is used in running the business activities has to talk about the cost of the business. Then we have the investing activities, cash spent on property and equipment, right? So we have factors of production that help a company to produce their goods or to carry out their operations. Cash are being invested in these materials, in properties, lands, equipment. So it's also part of the cash flow statement. The investing activity, then we have the financing activities, cash related to debt and equity, right? Talks about dividend and new loans. So this the whole The whole structure about the cash flow investment is just to tell you where the money came from, where the money went to, right? So that's just the summary of what cash flow statement is talking about. So this statement is the most honest statement a company can provide you with. A company can show you a profit on its income statement, but if the cash flow from operations, that's the CFO, is negative, the profit is shaking, right? So we want to see how strong and consistent the cash flow is in a business for us to be able to invest. So these are the financial segments of the financial statement that we have, right? So if you look at for other segments, we have talked about the scorecard, which is the first one. We also talked about the snapshot, which has to do with the balance sheet. And now this is the movement, which is the cash flow statement. So I will see you guys in our next video. Welcome to this video. So we are still in the business of fundamental analysis, right? So in this video, we'll be talking about profitability. And we're going to look at what profit margin is. So profit margin is the percentage of revenue that is retained as profit. Then the higher the profit margin, the better the chance for you to invest in such companies, right? Then we have what we call return on equity. Now, return on equity has to do with how much profit the company generates for every unit of shareholder equity invested, right? How much was the company able to make from the amount of money you borrowed to them to form the equity or the capital they used for business? Now, it helps to measure the management efficiency with the shareholder money. So you should be aiming for greater than 15%. So if the ROE is greater than 15%, that means the company is good to go. Then we also have return on asset. It measures how efficiently a company uses its asset to generate profit, right? So now ratios allows us to compare a small company to a large one or one bank to another side by side. Profitability ratio like ROE, return on equity, are critical. A consistently high return on equity, especially compared to rivals, signals a competent management team who knows how to reinvest profits effectively. That's for the growth stocks, right? So when you measure the return on equity side by side to the rivals or your competitors, and if the return of on equity is more than that of your rivals, you see that the company has a very good management structure, right? They have a very good management system for them to be able to make more money from the equity that was generated from the shareholder. So this is the profitability ratio that you need to check before you start investing or before you start buying stocks. That's why we call it fundamental analysis. All right, so in this video, we're going to talk about valuation and how healthy a company is, right? I think we covered this concept of PE ratio, price to earning ratio, in our module one. But here we're going to focus more on price to earning ratio compared to the growth of a company, right? So that's basically what we're going to do here. So why the PE ratio is popular, the PEG ratio, that's price earning to growth ratio, is superior because it factors in growth. So the price to earning ratio over a period of time grows, right? So when you factor in growth in the price to earning ratio, that's when we talk about the PEG ratio. We said it is superior to the PE ratio, and a high PE is okay if the growth is also high, right? So as you're looking at the price earning ratio, you're also looking at the growth of the company. Additionally, it is also advisable that you check your debt to equity ratio. Now, how much debt does a company have compared to how much they have as their capital? That's debt to equity ratio. It measures the financial leverage, right? So if a company have a high debt to equity ratio, it indicates a high debt risk. So in context, we have companies, let's take Nigerian stock market for instance. We have the banking sector and we have the tech sector. So a high debt level in a Nigerian bank may be acceptable due to regulatory requirements. So you can, if a bank borrows money and has a high debt, you can, let's say, consider it because it's a sector that is regulated, right? So but if you consider a bank, that does not mean you consider other sectors. So that's what I'm trying to say. The reason why we consider the banking sector, even when they have high debt, is because it's being regulated. But it could be a major red flag for a consumer goods company or consumer goods sectors, right? So any company that is not really regulated and has this debt to equity ratio, it's a big red flag and you should not invest in such company. That's what we are trying to say. That's the valuation and the health analysis under fundamental analysis, right? So if you look out for the PEG ratio, that's the price earning relative to the growth of the company, and you should also look out for the debt to equity, that's the debt to equity ratio. So whenever your debt to equity ratio is high, it shows that there is a high debt towards risk. And when you see such in a particular company, it's a red flag and it's trying to tell you that you should not invest in such company. I'll see you in my next video. All right, so in this video, we're looking at where to get your Nigerian companies report and how to analyze them. Although we are going to start from where to source this report from, right? So we said that the report, you can source them from the Nigerian Stock Exchange website, and the reporting standard used is the International Financial Reporting Standard, that's the IFRS, right? And we also need to be mindful of the notes regarding foreign exchange losses and specific regulatory provisions for the sector. We have different sectors, I've mentioned it in our previous video. And also we need to also pay attention because these reports are not, they are not released all the time, right? We need to pay attention when these reports are being released. They are released quarterly, half a year, annually. So these are basically the three timelines that Nigerian company release their results. Now the good news is that the IFRS is a global standard, so making Nigerian company reports generally consistent with international reports, right? So because we are using the global standard, it makes our reports looking internationally acceptable, right? So the way reports are being published in the international space, that's the way we also do it here in Nigeria. So it's consistent with the international reports. However, you need to always read the footnote, especially concerning loan impairment or currency exposure, as these are the critical variables in the local market. That's talking about the exchange rate and the fluctuations that has to do with the exchange rates, right? So you need to be checking out on these things so that you be in tune as you are reading the financial statement of any company. I'll see you guys in my next video. So in this video, we're talking about qualitative analysis that has to do with the quality structure of a company, management and corporate governance, right? So now we're going to look at the management quality. You need to evaluate their experience, track record, transparency and strategic vision, right? So any company you are investing in, you need to know their vision, you need to know their experience, you need to see their track record before you invest. Now, you also need to know whether the managers own a significant shares. If yes, their interests align with yours, because if managers of a company own a significant share, they will treat that share or that company as their business, right? Company like Nvidia, you see that majority of their shares is owned by the manager, the CEO. So such company, he will not allow the company to die because he knows that if the company dies, his money is going down, right? So you need to assess the company's ethic, the board independence, and the management compensation. So frequent if you notice that a company have frequent CEO turnover, they change their CEO all the time, let's say related to party transaction or accounting restatements, they have issues with their account and have a little bit of management issue, it's a red flag, and such company should not be what, you should not invest in such company. So all these things are things you need to look out for, how the quality of their management, whether managers or owners of the company have a major stake in the company, right? And the company's ethics, the company's vision, and how often they change there. You can see a company maybe in 1 year they will change CEO like 4 times. It's a very big red flag, right? And if that is the case, you should not invest in such company. So these are the qualitative analysis under management and corporate governance that you need to look out for before you invest in a particular company. I'll see you guys in my next video. All right, so in this video, we're looking at the micro factors and sector analysis. This is what we also call the top-down analysis. When you want to analyze the company, you don't start from the bottom, you start from the top, which is the sector, right? Now, you're going to start from the industrial landscape, which is the toppest. You are going to check whether the sector is growing or whether the sector is shrinking, right? We have different sector. We have the banking sector, we have the agricultural sector, we have the consumables sector, we have the oil and gas sector, we have different sector. So you need to look out for these sectors and know whether they are doing well as a sector, not as a company now. They are doing well as a whole, as a sector, before you even try to invest to bring it down to the company, right? That's why we call it a top-down analysis. Now, you're going to look at the competitive or competitors landscape. How does the company stack up against its closest competitors in terms of market share and pricing power, right? So you need to compare. Why we talked about ratio, profitability ratio between two companies. Compare the two companies, know their market share, right? Look at their market caps, their pricings. Look at all these things, analyze the two companies' income statement before you make a decision. Then look at their debt cost, and also you also need to take note of inflation, because inflation can increase the cost and shrink profit margins, right? You need to look at all these micro factors before you make a decision of picking a stock. So before you pick a company, you must pick a team. Don't invest in a shrinking industry. Then zoom out and consider the micro environment. Will high Nigerian inflation hurt this company's raw material costs? Will high interest rates make their debt too expensive? Good investment starts with a top downward view, right? So for you to carry out good investment, you need to look at economic indicators like interest rates, because when there is high interest rate, it might affect their debt, the cost of the money they borrowed. Let's say that they borrowed money at a particular rate and the interest rate increased, right? Then paying back that money, you have to pay with the current interest rate, and it will affect the business. Now, in terms of inflation, if there's the price of commodity increase, right? The price of the cost, what it took them to produce a particular commodity increase, that means it also affects their cost of production. That's why we take note of economic indicators like interest rates, inflation, and the GDP. So these are the micro factors that helps us to analyze company from the top to the bottom. That's the top-down analysis, right? And it can also be called the sector analysis. I'll see you guys in my next video. All right, so this is where the juice is. We are going to look at how to determine the intrinsic value, how to evaluate a company, right? So the goal here is to project the company's future earnings and discount them back to today's value. So the two ways in which we can look at the intrinsic value of a company is through the discounted cash flow and the multiples valuation. Now, when we talk about this discounted cash flow, you are trying to estimate the present value of all the future cash flows. So it's just like projecting into the future what a company will look like, or the worth of a company, let's say in the next 10 years, and discounting it to the actual value to compare and contrast between the two, right? So, but the challenge here is that it is highly sensitive to assumptions like growth rate and discount rate. So when you're able to project the actuals, the actual worth of the company, or you are trying to look into the future of the company and know how much they'll worth in the next 10 years, and you now discount it to the actual uh, value of the company, and now compare and contrast between the two. Then we also have the multiple valuation, which is the simplest method. Here you compare the company's price to earning ratio or price to sales ratio to its peers, right? Now you're looking at its competitors side by side. Now, if the competitor trade at a price earning ratio of 10x and ours trade at 8x, it may be undervalued. Now, what we are trying to say here is that the price earning ratio is the price per share to the amount of money the the company makes, right? Let's say that the price the company makes or the company earns in one share that they sell to the public compared to the price of the stock itself. So that's the two things you are going to compare for you to get your multiple valuation. And that's how to determine the intrinsic value of a company. I'll see you guys in my next video. Wow, wow, wow. So welcome to the last slide of module 4. Honestly, it's been a ride. Now you possess the toolkit of a value investor. Financial analysis is a skill, not a secret. The only way to get better is to practice, right? So the action step we're going to take today, you're going to download a report today. In our next module, we'll explore the technical analysis, the act of predicting price movement using charts to help you time your entry into the market. So I'll see you guys in module 5.